Hello, we're going to continue with Chapter 9, and today we're going to talk about areas of high risk, indicators of risk, related party transaction, non-routine transaction, judgment, complexity. Related party transactions are high risk. That's different than saying they're bad. All businesses of any size or consequences today are related party transactions. They're not bad. They're part of business. But we should be aware that related party transactions are riskier. The definition of related party transactions that I want to use is any party with which the audit client deals where one of the parties can influence the management or operating policies of the other. The audit client may be able to influence the management or operating policies of the related party, or the related party may be able to influence the management or operating policies of the client. It can go either way. The risk associated with related party transactions is because one party can influence the other. They can structure transactions that might conceal problems in the financial statements. So Enron had literally thousands of related party transactions, related entities with which it dealt. And it could move assets off of its balance sheet into the balance sheets of these related entities. So it often took assets which were not worth as much in reality as they were on their balance sheet, and rather than recording a loss, they moved them to the balance sheet of these related entities. So related party transactions aren't bad necessarily, but they are risky because companies can use them to hide problems. Non-routine transactions. If you go think about it, it almost goes without saying. We usually get better when we do something more often. So if we don't do something very often, we're probably not very good. Banks are extremely good at processing deposits and checks. They do millions and millions of them. And so they can afford to invest in a very sophisticated control system to make sure they process deposits and checks correctly. If you only do something once every 10 years, you really can't afford to invest in controls for that type of a transaction. The bank can spread the cost of their controls over those millions and millions of transactions. If you only do a transaction once every 5 years, you're not going to make a major investment in controls because you can only spread it over that one transaction. Judgment. Estimates. Do we really know people that have good judgment? Now, KPMG, they have 4 audit approaches: reduced level control risk, substantive approach, estimates, and disclosures. They have a different audit approach for estimates because estimates are different. They're risky. We're just going to touch on estimates later in the quarter very, very briefly. 90% of what we're going to talk about are either the reduced level control risk approach or the primarily substantive approach. But estimates are a problem because they involve judgment. We need to keep track of the differences. One of the reasons estimates are risky is often there is no right answer. We're going to compare the client's estimate with our estimate. How do we know the client's estimate? Well, that's easy. It's usually recorded. A client buys a truck for $10,000. It's pretty easy to establish that the cost was $10,000. It's more difficult to establish whether the truck's going to last 6 years or 8 years. We think the truck's only going to last 6 years. The client believes it's going to last 8 years. We can see the difference in their records. Bad debt expense. So we're going to keep track of these estimates. So we estimate bad debt expense should be $162,000. The client recorded $120,000. We estimate inventory at lower of cost or market should be $75,000. The client recorded it at $62,000. So we can keep track of the income statement. It's just keeping track of debits and credits. I don't care what the account title is. A debit on the income statement reduces net income, and a credit on the income statement increases net income. So that's pretty easy. On the balance sheet, I might want to split it up between assets and liability, or current assets and non-current assets, current liability. I may get a little bit more sophisticated than just these two columns for assets and liabilities, but I'm going to keep it simple. Now, if I look at the income statement, I want to make sure that I would assume that some of the estimates, my estimates would decrease their net income and some would increase. I understand that management has a bias. So if I've got 10 estimates, I wouldn't be surprised if 6 of my estimates would reduce net income and 4 would increase it. I understand management is biased. But if all 10 of my estimates would reduce their net income, then I start to become suspicious that management is overly aggressive. I'm going to create some type of chart like this, compare my estimates with their estimates. I can't usually say they're wrong. Can I say the estimate's wrong? Is it reasonable? If it's reasonable, I pretty much have to accept it. Complexity. Again, doesn't it go without saying? We would all rather do something simple and straightforward than complex. If we read about Enron on page 304, we become aware that Enron had massive complexity, which in hindsight served no legitimate business purpose other than to confuse the auditors and make their life difficult. Professional skepticism, an attitude that includes a questioning mind, being alert to conditions that may indicate possible misstatements, and a critical assessment of audit evidence. So this is thou shalt know. Tomorrow we're going to talk about the effectiveness of internal controls and how it affects our audit approach. Thank you.